We just finished going through Amphenol's 2026 Q2 earnings call materials, and now we want to share our takeaways with everyone. Look, everybody on financial media is arguing about the same thing right now: which chip wins, which model wins, which hyperscaler wins. And I'll admit it, I've played that game for years, and I've mostly gotten it wrong. Meanwhile, there's a company sitting off to the side that doesn't care which one of them wins. It sells the wires, and this quarter it took in $123 of new orders for every $100 it shipped. Let's get into it, cause this one genuinely got me out of my chair. The cover sets the frame, and the word they chose is anomaly. This is titled the AI Interconnect Anomaly, and Amphenol 2026 teardown. The subtitle underneath reads Institutional Analysis, Structural Winners in AI Hardware. Two words there are doing all the heavy lifting, and I want you to hold on to both of them. Anomaly means something in these numbers does not behave like a normal quarter. Structural means whatever is happening isn't a one-quarter spike, it's built into how the industry now works. Our read is that a deck opening on structural winners is making a very specific promise. It's promising that the thing driving this quarter will still be driving it 3 years from now. That's a high bar, and it's the bar I'm going to hold every single page to. So let's find out whether the numbers earn that word, or whether it's just a nice cover slide. Alright, here's the number that started this whole thing. The company reports Q2 revenue of $8.8 billion, a record high, up 55% year over year and 30% organically. But then orders came in at $10.7 billion, also a record, up 94% year over year and 63% organically. That's a book-to-bill of 123, and the page puts it in plain English for you. For every $100 shipped, $123 in new orders walked in the door. Picture a restaurant serving 100 dinners tonight and taking 123 reservations for next week while it's still cooking. That's a $1.9 billion gap between what they sold and what they were asked to sell. And crucially, the company notes this is not an isolated spike because all 7 end markets posted positive book-to-bill ratios. Now here's the honest pushback, and it matters in a supply crunch. Customers double, order to hold their place in line. Our take is that one quarter at 1.23 is exciting, but 2 quarters of it is what makes it real. Before we go further, let's be crystal clear about what this company actually sells. The page frames it as one core question: is the total interconnect content increasing? And in AI, the company's answer is that they need more of everything: power, copper, and fiber. On the way in, power interconnects, high voltage, liquid cooling integration, and complex power harnesses running from the grid all the way into the deep rack. In the middle sits what the page calls the black box, the compute, the GPUs and the chips. And the page is careful here. Amphenol does not make chips, they just feed them. On the way out, high-speed copper and optics, moving data through passive and active optical interconnects. Electrons entering, tokens exiting, and this company owns both ends of that sentence. Shovels for the shovel makers, as the page puts it. Our read is that this is the least glamorous position in the entire AI trade, and quite possibly the most defensible one. You don't have to be right about the future, you just have to sit in the path of it. Here's the data across all 7 markets, and it is not evenly distributed. The company reports 5 of 7 markets significantly outperformed internal expectations. IT Datacom is 43% of the business, up 63% organically, and the page says it's almost entirely driven by AI products. The Q3 outlook there is mid-teen sequential growth on top of that. Industrial 20% of revenue, up 18% organically, with growth across every subsegment and every region. Defense up 24%, commercial air up 21%, and mobile device up 14%, with a surprise 9% sequential jump. Automotive up 6%, which is fine, but nothing to write home about. And then there's communications network at 11% of revenue, down 6% organically. Q3 guidance there is a mid-teen sequential decline, and it's the one red box on this page. Here's the line I'd write on your notepad. IT Datacom's 43% share dictates the company's gravity. Our take is that 6 markets can be doing beautifully, and this stock will still trade on whatever AI does next. Now let's talk about the acquisition, because this page genuinely surprised me. The company raised CommScope's house to a 2026 revenue outlook from $4 billion to $4.6 billion, a 12-cent increase. Fine, nice, a solid bolt-on. Then look at the earnings line. CommScope's 2026 EPS contribution went from 15 cents to 30 cents, a 100% increase. Revenue up 12%, earnings up 100%. That gap is the entire page, and the page explicitly crosses out pricing power as the explanation. What it credits instead is factory and expense execution, with operating margins already exceeding 20% including amortization. The company's conclusion is that value creation comes from applying the Amphenol operating model to under-optimized assets completely independent of market tailwinds. Read that last part again, because it might be the most important sentence in this whole deck. Independent of market tailwinds means this piece keeps working even if AI orders cool off. Our take is that acquisition math like this is either genuine operational skill or aggressive accounting, and the margin disclosure points toward the former. Two things came with CommScope that the company says are not fully priced into forward modeling yet. First, completing what the page calls the AI triad. CommScope's IT Datacom business, which is nearly doubling year over year, is entirely optical. The company says that immediately cements Amphenol's scale as a global leader in complex AI optical interconnects. They were already dominant in high-speed copper, so now they sit on both sides of the copper versus fiber argument. Whichever way that architecture debate breaks, they are selling into it. Second, the page highlights an established distributor network reaching 150 to 180 countries. And the company says Amphenol is already moving to push its legacy interconnect and sensor portfolios through that newly acquired global pipeline. That's buying a customer list and a warehouse of products, then running your own products through the same trucks. Our take is that the channel is the quieter of the two gifts and probably the more durable one. Now the margin, and this is where management earned real credibility with me. The company reported an adjusted operating margin of 29.8%, a record high, up 420 basis points year over year. Gorgeous number. But sitting inside it is an $80 million IEEPA tariff refund, worth about 4 cents of EPS. Strip that out, and the clean operating margin is roughly 29%. Here's the part that matters. Management voluntarily isolated that $80 million benefit and entirely excluded it from Q3 guidance. Nobody forced them to do that. Plenty of teams would have quietly let it flatter the base and made next quarter's comparison that much easier. And once you adjust for the tariff, the company says clean Q3 EPS guidance of $1.40 to $1.42 represents 7 to 8% true sequential growth. So the headline was inflated. They told you it was inflated, and the underlying number is still strong. Our read is that how a management team handles a one-time gain tells you more than the gain itself ever will. This one handled it about as cleanly as you'll ever see. So how does a company this size actually deliver into a supply crunch? The page contrasts two structures, and in my opinion this is the real moat. The traditional model funnels thousands of suppliers through central procurement and then out to the end market. Amphenol runs roughly 150 general managers, each with their own local suppliers and their own local customers. The page's framing is speed over scale, and here's why that matters right now. The company reports total scale doubled in 2 years, 1/3 from M&A and 2/3 organic. Doubling in 2 years required thousands of suppliers to scale up simultaneously. And management is quoted saying they haven't seen any broad bottlenecks limiting their ability to deliver. The reason they give is blunt, because this isn't managed at headquarters. To be fair, the bears would say 150 general managers is also 150 chances for something to go wrong. But our take is that in a shortage, whoever can say yes fastest takes the share, and centralized companies are slow by design. This page puts management's headlines next to what they actually mean, and I like decks that do this work. Management highlighted record orders and a book-to-bill of 1.23 across all 7 markets. The translation organic orders up 63% prove this is real demand, not M&A bloat, and the Q3 guide of $9.3 to $9.4 billion leaves a massive unreflected backlog. In other words, they're guiding to less than the order book implies, which is the direction you want that error running. Management highlighted that CommScope EPS guidance doubled. The translation, so value creation relies on the operating model, not AI market wins, and the page says it well. Market wins fade, operational models endure. Management highlighted the record 29.88% margin and 1.3 times net leverage. The translation, high management credibility, because carving out that tariff refund handed analysts a clean baseline for Q3. Now notice something unusual about this whole matrix. Our read is that on most decks the translation column deflates the headline, and on this one it mostly confirms it, which is rare enough that it's worth saying out loud. Alright, now let's be a referee, because no company is ever this clean. The page lists 3 cracks and I'd take every one of them seriously. First, over concentration. IT Datacom now commands 43% of revenue, and sequential growth is almost entirely AI dependent. The page states that diversification metrics mathematically degrade at this scale, and that's just arithmetic, not opinion. The thing that made this company safe for decades was that no single market could sink it. Second, the black box. Management outright refuses to break down AI revenue by fiber versus copper or quantify specific scale-up architectures. The page says that makes precision modeling impossible, and I would underline the word impossible. Third, the telecom drag. legacy communications network declined 6% organically, with Q3 guiding to a mid-teen sequential decline. It's the only market untouched by the AI rising tide, and that's a real business quietly shrinking in the corner. Our take is that none of these break the thesis, but the black box is the one that should bother you, because you cannot test what you are not allowed to see. Here's the structural argument, and it's why this deck put the word anomaly on the cover. 3 gears turn together, according to the page. Compute density up, meaning more chips per rack. Power demands up, meaning higher voltage and liquid cooling. And architecture agnosticism, meaning they supply copper, fiber, and PCB regardless of which AI model ends up winning. Turn those 3 gears together and you get exponentially more connections per rack. Then comes the sentence that I think is the entire investment case. While hyperscalers bet billions on the right chips and the right models, Amphenol only has to bet on one physical reality. Total interconnect content per rack will increase. That's it. That's the whole bet. Our take is that this is a lower variance way to own the AI build-out than picking a chip, and lower variance is worth paying something for. But it is not a free lunch, because if the build-out pauses, more connections per rack doesn't help you at all. The company closes with what to watch, and it's a short, genuinely usable list. Leading indicator first, the book-to-bill ratio staying above 1.0. Q2 was 1.3, and the page warns that if it drops below 1.0, that backlog is being consumed rather than replenished. That is your single most important number next quarter. On profit quality, watch CommScope margin holding above 20% and free cash flow conversion, which was 68% in Q2. The page flags monitoring whether rapid growth traps more working capital, which is the classic way a booming manufacturer runs itself out of cash. On risk, watch for telecom network stabilization and watch the CapEx spending rate. That last one is clever. CapEx sits at the high end of the 3 to 4% range, and the page says an increase signals deep internal conviction in the order book. Management spending its own money is a confident signal you get before the press release. And the CEO is quoted with the honest caveat, we only rely on people continuing to invest. Alright, last thing, radar always leaves you a light. I'm calling this one yellow, and I want to be precise about why, because the business itself is excellent. Book-to-bill of 1.23 across all 7 markets, a clean margin they voluntarily disclosed, and an acquisition that doubled its own earnings contribution on execution alone. That is not the part giving me pause. What stops me at yellow is that 43% of revenue now rides on AI, and management will not break that number down for you. I can't test what I'm not allowed to see, and nothing in this deck tells me what price you're being asked to pay for it. I'm about 70% on this one. It turns green when book-to-bill holds above 1.0 for another quarter and management starts breaking out the AI mix. It turns red if that ratio slips under 1.0 while IT Datacom is still 43% of the company. And if they hold that number next quarter, I'll happily say I was too slow, and I'm telling you that up front. If you like this kind of analysis, the kind that does not ride the market's mood and stays locked on industry data and hard logic, please subscribe to Value Stock Radar. Hit the bell, like and share. Your support is what keeps us digging through the financials and hunting down quality names. This is Value Stock Radar. See you next time.